more I watch the market on a daily basis, the more I realize, markets move more on human emotions, fear, greed, stuff like that, versus what's on paper, what everyone sees and understands. If everyone has access to the same information, then there's no real edge. If we all say, "Oh, hey, any stock that has a PE above 20 is overvalued," well, then I don't see
So
really
when
the
you
the
began back
edge
in
in that.
2010,
It's all about realizing, hey, this is a long game. Doesn't matter if you're a day trader or a swing trader. You need to survive the drawdowns. You need to survive the tough market environments, because when things turn, that's when you can make your year in a quarter, or have a blowout year where you make enough money to pad your returns for several years to come.
great morning out there for everyone. Welcome back. We're tracking a massive, moving macro development today that demands your immediate attention. The fragile ceasefire is officially over. Over the last 48 hours, the geopolitical chessboard completely ruptured, and the U.S. and Iran conflict escalated to a dangerous new tier. President Trump said the ceasefire, he was done with it. With the White House declaring the interim agreement finished, U.S. Central Command has launched heavy retaliatory airstrikes against nearly 90 targets inside Iran. This comes directly against a wave of attacks on commercial shipping vessels transiting the Strait of Hormuz, the world's most critical energy corridor at the time. Right now, oil markets are spiking, regional defenses across the globe are on high alert, and the global supply chain is facing immediate shock. But as you know, on this channel, we don't just look at the headlines, we look at the bottom line. This isn't just a regional conflict, it's a direct variable hitting global energy security, corporate inputs, and future inflation metrics. Today, we're bringing on an emergency real-time 1 hour tactical breakdown where Main Street and Wall Street connect. Excited to have Gianni Di Poce join us. Gianni, it's critical to have you on right now, man. How are you feeling this morning?
I'm feeling good, Marcus. How you doing?
Doing great. I'm doing great. I'm doing great. Let's just go ahead and jump right into it. For anyone watching, let us know where you're watching from. Appreciate you tuning in. What are you seeing in the markets right now?
Well, what's crazy to me is the timing of these latest developments. Obviously, whenever something like this happens, oil spikes, and people start talking about it. Oh, hey, geopolitical stuff leading to oil surging. But if you actually zoom out, and I love to say, when in doubt, zoom out. Oil is fresh off of a 4-week consecutive drop in prices. So to me, the timing is what's most interesting. I mean, you drop 4 weeks in a row in oil, you get a 2 to 3 day spike, you get this headline, and everyone rushes to attribute it to the Strait of Hormuz. So I'm a charts guy. I think it was a pretty logical area for oil to bounce. But like you mentioned in the introduction, this is a pretty difficult position for the markets because it's putting pressure on bonds that affects global liquidity in stocks and other markets. And so that's the point of fragility that I'm watching, and I'm starting to see this, create some stress in the bond market.
Yeah, and is this consistent with what you've seen with other geopolitical conflicts? Like maybe if we just go back to the Ukraine-Russian conflict a few
Yeah.
years back.
Yeah, absolutely. When you have as much debt that we have, all the developed economies in the world, the US, European Union, Japan, you look at their debt to GDP ratios, they owe more money than their economy is worth type thing. So whenever inflation spikes and interest rates go up, it means that when they borrow in the future to refinance their loans, it's going to cost more and more to do so. I mean, I think now, like for example, in the US, from all the federal tax revenues, around 20% of that goes just to service the interest on the national debt. And so that's a pretty significant line item in their budget now. And so that's just, the normal dynamics of the market. When commodities spike, when oil goes up, it increases inflation expectations. Bond markets are designed specifically for interest rates to generally track the rate of inflation. So oil spikes, interest rates spike, bond markets sell off, liquidity becomes a bit more fragile, and then eventually that spills over into stock markets.
Gotcha. Yeah, and that just the general inflation and what people are seeing and feeling at home. Like you can have these headline numbers, you can see the data, but what you're actually feeling as you swipe these cards are really impactful. Another thing that I've noticed with the war, it seems like when it first began, everything was about the war. Like that was all you saw in the headlines every day was like the first thing in the morning, top of the morning news. It was moving the markets. Now we're seeing that push back to the second, third, fifth story. Do you think that's just kind of getting glazed over?
No, I think that, there's almost headline fatigue in a way, right? And it was interesting, back to oil real quick. If you look at when oil topped out, it topped out back in early March, and the conflict didn't really settle down for another few weeks later. You didn't see that ceasefire or that truce for another few weeks. So, markets are forward looking by design, and I think that we've played ping pong so many times. Oh, where there's no deal. Oh, there's a deal. The joke is like every time there's an escalation in the tensions. We have another opportunity to reprice peace into the market, and so the markets rebound. So eventually, these announcements are going to stop having an effect. And I think that it's finally starting to catch on. The fact that stocks have, held up so well, even with the latest announcement, I think is a good thing. As a rule, when bad news doesn't lead to bad outcomes, that's usually good. Just like if good news doesn't lead to a good outcome, that's usually a signal that, hey, you need to be a little careful.
Right. And not to run too far from the Iran geopolitics, but we've seen that with earnings here recently, where bad news was good news, where you needed like exceptionally great
Yeah.
reports on your earnings for you to have actual great returns. Do you think that's we're getting back to a normal market area where bad news is bad news and good news is good news again?
That's a tough call on that one. I would say, yeah, I think so. I mean, the earnings season from Q1 that we had last quarter, that was the best earnings season we had in about 20 years. So we're coming into earnings season again. Stocks have rallied for about 3 months now. We're getting late in some of the cycles that I like to track. And so, yeah, I think that if you do have bad news, there is a cyclical component to leading to a negative outcome here over the next few months. However, if you get good news and it doesn't translate to positive results, then that's also, a time we're gonna have to be a bit cautious.
Right. So, and we're talking about geopolitical tensions, and like I said, we'll dive back deeper into the earnings. This Iran war, like the escalation since the time we set this up, is actually escalated a lot more. Yesterday, President Trump had to
Yeah.
turn down, cut his trip short, switch Air Force Ones on the way back. Do you see any of this playing into any of the international markets?
Yes. Well, international markets have been doing very well over the last 18 months or so. So what's interesting is that this has been a theme that's been going on for quite some time. But when what starts to hit the fan, usually what you see is a rush back into the US market. The US market is still the safe haven market of the world. Dollar reserve currency status. When things hit the fan, people want to own dollars. They want to own dollar denominated assets because there's more confidence in the US system than any of the other ones. So, some of the markets I've been tracking closely internationally, especially in Asia, include South Korea and Japan. South Korea's, their market is their index is, I think almost tripled. Year to date, it's gone absolutely insane. You have stocks like SK Hynix that have gone absolutely nuts. So, even though geopolitics are in the background, it's still it's been an AI driven, semiconductor driven market. And so now at this point, because of the returns we've seen, we need to see rotation. You need to see other areas of either the AI trade. You need to see the AI trade evolve. You need to see the tech trade, pick up some other areas of the sector. But if oil continues to spike or it starts to spike again, those countries, especially in Asia, they're a lot of they're net oil importers, and usually they're exporting their goods, right? So they don't have as many natural resources. They have to import oil to run their factories, to run everything in their economy, and so if their input costs go up, that translates to, they're going to have to raise prices on their exports, and that creates a whole nother round of problems. So, the Asian, region is definitely more susceptible and more vulnerable economically to spikes in oil prices. And, what's interesting about that is you actually, in the last week or so, you've seen Saudi Arabia start to sell oil at a discount from the market price. And I think it's because you're starting to see such wide disparities across the globe on regional energy prices, a lot of arbitrage opportunities, from regional standpoints, because, they're still commanding a premium, on that eastern area of the world because of the conflict. Meanwhile, here, in the US, oil prices are a bit more subdued. That's why you have the difference between WTI, West Texas Intermediate, and Brent. So that's a big thing that I'm watching, because if oil starts to spike again, it could really put markets like South Korea and even Japan on the hot seat.
Yeah, you mentioned the Kashpi over there in South Korea and Japan area. What do you think any impact of tariffs will be? If let's just say the president was to say, we're going to put 30% tariff over there in South Korea or Taiwan area, somewhere where we're getting major chip and memory production.
Yeah. Well, it's interesting. I think that's part of a broader geopolitical alignment taking place. I mean, you look at what happened earlier this year in Venezuela and even some of the recent elections in South America. I think there's a regional realignment taking place. And I think it's also a big reason why we're trying to bring back, semiconductor manufacturing into the United States, because I don't know that the current system that exists is going to continue. I think it's very vulnerable. I think China wants Taiwan. I think China wants to expand its influence in the South China Sea and in Asia in general. And I think part of the backdoor deals that have been going on is, hey, we're going to take control of our hemisphere. You can have control of your hemisphere. And then, to each, we can each go our own ways. So I think that is a point of vulnerability. The tariff thing, I think the market is exhausted from that at this point. You had some recent headlines with that with the European Union, and that was like maybe a week or two ago, and the market kind of just shrugged that off. So last year it was tariffs, this year it's Iran. I don't know what's going to be next year, but each year there's some reason to be scared. But that's why I try to focus on the price action above all else. The market's forward looking, the market prices in the risks, and at some point, the risks get exhausted and the reward, starts to outweigh them.
Right. So what are you looking for in market prices right now? If so, you're looking outside of all the noise and just focusing on like
Yeah.
the actual fundamentals, or are you more of a technical investor where you want to look at the momentum?
Yeah, I'm more on the technical side. When I got into the business, I was more focused on fundamentals. When you're going through a lot of the programs, they push you into fundamentals. But I got into trading like in the early 2010s. So, during that time you had stocks like Apple, like Amazon. They weren't considered the Mag 7 or the Mag 10 back then, right? And their fundamentals weren't exactly fantastic. And so I was always skeptical. Oh, hey, what's wrong with Apple? What's wrong with Tesla? What's wrong with Amazon? Like, these stocks shouldn't be going up. Their fundamentals are all out of whack. And they kept going up. And so, the more I watch the market on a daily basis, the more I realize, markets move more on human emotions, fear, greed, stuff like that, versus what's on paper, what everyone sees and understands. If everyone has access to the same information, then there's no real edge about that. If we all say, "Oh, hey, any stock that has a PE above 20 is overvalued," well, then, I don't see
So
really
when
the
you
the
began back
edge
in
in that.
2010,
So that's why I think
what
that
were some of the early
focusing on the
lessons you
price
learned?
action, the trends, the patterns, the momentum, that's definitely a first step in developing an edge in market navigation.
Well, there seems to be a pause here. Gianni,
Yeah.
there you go. Sorry, it kind of faded away a little bit. Did you catch my last question on when you started trading back in 2010? What were some of the big things that you saw?
No, I didn't catch that last question. Could you repeat it?
Gotcha. The love of the joy of life stuff, man. My bad. You said you began trading back in 2010. When you began trading back in 2010, did you? What were some of the early lessons you learned? You're
One more
back.
time, please.
Forgive us all. A little live TV going on. All right, Gianni, we good? Can I see you? You can see me. We're back to. I didn't hear your answer. Maybe the world did,
No, I didn't
but
hear
I
your
can see you.
question, so let's try it again. Okay, I see you too. Yeah,
All right, you can hear me now.
yeah,
It says the device is struggling over here. Can you hear me now, G? It's frozen again.
yeah. I hear you.
Back. All right. So my question was, you began trading back in 2010. What were some of the biggest lessons you learned early on trading?
Wow, well, that's a really good question. I think that the market environment that is ongoing when you start trading can leave a big impression on you. And there is a big thing about beginner's luck. So I started trading. It was the early 2010s. It was 2012 I started trading, and we were a couple of years after the global financial crisis. We were in the early stages of a new bull market, and the first year that I was trading, I had some decent success, but I almost think that's a an obstacle to overcome, because when you start off in trading and let's say the market is doing well, you think, oh, this is easy, this is beginner's luck, like this is going to be an easy way for me to extract money from the market. But it's not always like that. The challenging market environments are really what define you more as a trader. So yeah, what I would say is be aware of the market environment that you're operating in, because if you're in a strong market environment and you're performing well and you're early in your trading career, it's not always going to be that way. So don't take it for granted.
You got that right. When you began trading, did you have, so like, it sounds like you had some big wins to begin. And then how did you react to those first losses? Because that's the thing with trading. You're always going to have losses.
Absolutely. Well, it took me a few years to figure out risk management. That was a big thing. I grew up here in Metro Detroit, not exactly a big finance culture. I never went to Chicago, never went to New York. I really learned how to trade on the internet. It's very much a modern way of trading. I've been fortunate enough to rub shoulders and trade alongside some guys online now that they were in the pits in Chicago. They come from the finance culture of New York. So I've learned a lot from them too, but very much had a different path, an unusual path in that regard. And that's actually what enabled me to survive. Because the thing is, if you blow up your account, and I'm not proud to say early on in my career I blew up my account, which is normal, but in this day and age, there's so much more information out there. There's so much more resources for you to learn from. Understand the math behind your strategy, understand the math behind your portfolio, because what you're trying to do is survive during the tough times. When you get back into the good times, that's when you can really thrive. And so yeah, that's my thing is, if you blow up your account, you're out of the game. And if you're out of the game, you can't play. If you can't play, you can't make money. So it's all about, realizing, hey, this is a long game. Doesn't matter if you're a day trader or a swing trader. You need to survive the drawdowns. You need to survive the tough market environments, because when things turn, that's when you can make, your year in a quarter, or, have a blowout year where you make enough money to pad your returns for several years to come.
Yeah, you got to learn to lock in the risk. And like you said, you got to mitigate it. The market that doesn't just grow straight up to trees. What would you, and for the folks listening, there may be some people listening on the Main Street side, go into a little bit of, when you say a day trader versus like a swing trader, what's a little bit of difference in there? That's a little nuance, right?
Yeah, yeah. Well, a day trader is simply someone you're in and you're out in the same day. Usually, if you're day trading, you need to take on some leverage. Whether you're trading futures, whether you're trading, zero DTE options, usually you need that to make day trading worthwhile. But whenever someone's getting started, I don't recommend that they start in day trading. I think you want to zoom out your time horizon. This is completely different from investing. Swing trading, you're holding positions for a few days to a few weeks, and then even position trading. I that's my sweet spot is kind of between swing trading and position trading. holding trades for a few days to sometimes even a few months. It's if it's really working, because there's a big thing in this business, cutting your losses short and letting your winners run. And so if I identify a good setup and it's working well, I'm not in a rush necessarily to get out of that position, after a few weeks. I mean, in fact, some of my best trades, my triple digit winners in most cases, outside of leverage style trades, I'm holding for a few weeks to a couple of months. And so, usually there's two or three really good buying opportunities in the market per year. And so I try to structure those, longer holding trades around those, around those rebounds coming out of those corrections. So what I would say is, don't jump in on the shortest time interval. Give your time to adjust. Watch the market more. You'll see how the market fakes people out on one side into the other on a daily basis. Day trading's hard. I'd say out of all the traders I know, the ones that are successful are mostly not day traders. I know some successful day traders, but they're the fewest number of successful traders that I know. Most of the successful traders I know are in the swing to position trading camp. So, you know, that's what I've experienced on in my own journey.
Right. And do you include options trading in there?
Yeah, I mean, options. You just have to look at your time horizon, right? I mean, that factors into the value of the option with time premium. You have theta decay. I trade a little bit of options. I actually prefer futures because of that time decay factor in the pricing of options. Basically, when you have the options premium, part of the value is the price of the security relative to your strike, but the other part is how much time is left before expiration. And so, what I like about futures is you're not necessarily punished for a few days of sideways action in a position, whereas in options, you would be.
Yeah, options are very interesting to hop in and hop out, and then futures. Yeah, speaking of the futures are green right now as we get ready to open up this market. How would you take me through your morning if you're as you're going to trade today? What would that look like? Like versus yesterday where the futures were very red versus Tuesday where the futures were green. So
Yeah, right.
walk us through it.
Yeah.
Take us from Tuesday through today.
Yeah, so Tuesday, we came into this week basically in some chop. The Dow hit a new all-time high on Tuesday. But, on Monday you started off, obviously we were closed on Friday for the 4th of July holiday. Monday you came in, a bit of a holiday hangover, if you will. Tech and the Nasdaq were doing well. Tuesday you had that rotation trade in play, but yesterday and even into today, you're seeing tech and the Nasdaq start to outperform again. But, most of my work as a trader, if you want to call it my homework, actually happens after the market close. In the morning, I try not to pay attention too much to the market for the first like hour and a half of trading. So from like 9:30 a.m. to around 10:30 to 11 a.m., the only thing I'll do during that time is capture gains or book profits. I'm very, very rarely initiating any new positions during that time. You have to understand that, European markets, around that time are closing. You consider they're 6 hours ahead from Eastern time. So, they close around 3:30, 4 p.m. their local time. And so that's around the time that we're opening. And so there's a lot of money shuffling hands. There's a lot of chaos, a lot of retail traders chasing the morning headlines. And so I try to just step back and take my shots as they come. I'd say around 80% of my trade entries happen around the closing bell. But when it comes to booking gains, I'll do that at any time of the day. And of course, it depends on the style that I'm trading. If I'm doing a swing trade versus a breakout style trade, I'm a bit more forgiving trading during the day on a swing style trade versus breakout. That's going to be, near the closing bell. So yeah, I mean, I try to pick my moments, pick my spots of when I'm initiating trades, and try not to react to the headlines, because the headlines are there to fool you into making a decision that wasn't planned. Or that's what I'm saying, like my homework gets done at night. I always have a plan coming into the next day. I'm not just like shooting from the hip, like, hey, I'm going to buy this because of this headline. No, I never do that. And I had to learn that lesson the hard way over the years.
Yeah, that's good work. Yeah, most of the hard work's done. professional players are shooting those shots when people aren't watching so that when it comes time to take the shot,
Yeah.
you're ready to take it. Or if the shots on
Yeah.
goal, I guess we're in a World Cup season right now, like whatever Messi did the other night, he can't just summon
Yeah.
that. He can because he's done it so much, like, and put in the work. What calluses do you generally look at when you do your overnight work before you going into the next day?
Yeah, well, the closing price is the most important piece of data on the day. I don't really care. I mean, there's some daily levels that I watch that are, partially calculated from the high and the low of the day and the close, but I'm always looking to see where we closed relative to the previous day. And, that even applies on Friday. For me, the weekly close is very important and even the monthly. So, time intervals, the closing prices across various time intervals, that's very important as well. So I'm always looking to see how we closed relative to the previous time interval. Did we close at the highs? Did we close at the lows? Were we at the highs and we gave back those gains? Were we at the lows and we recouped those gains? Kind of like we had yesterday, right? The Nasdaq was down all day, closed off the lows, closed slightly in positive territory, and now it's leading again. So those are the types of observations that I look for because you mentioned that the World Cup, right? That game Argentina versus Egypt, right? One of those things. Egypt's winning the whole game. Last 10 minutes, Argentina comes back and wins it. Well, who won the day? It's the same idea between Bulls and the Bears. Bears were winning the day
Yeah.
yesterday in the Nasdaq. Bulls came back at the end. They won the day, and now they're up today. So never judge a trading day until the closing bell. And I think it's a very important lesson that people watching should take away from the market.
Yeah, it's good stuff. And I like how you mentioned earlier that you don't trade at the beginning of the day because of the moves inside of the European market opening or closing, I guess it's closing at that time. What about another time that I've noticed, like when it's really choppy to trade is like right after, well, I guess we'll see with Kevin Warsh, but right after Chairman Powell would speak. So right before you speak, like 2 o'clock to 2:30. That seems like whatever happened in that time,
Yeah.
the opposite was going to happen for the rest of the day. Like if it went up, it was going to be down. If it went down, it was going to be up. Do you see other
Yeah.
signals like that inside trading?
Absolutely. When it comes to Fed Day, my golden rule for Fed days is the day after Fed Day matters more than Fed Day itself. I mean, you have all these algorithms that are coming in and dissecting every single word that these Fed chairmen say, and they're trading based off of what they say, and so it's very chaotic. And during that time, no one's forcing you to take a trade, right? Trading is the ultimate accountability profession because no one's over your shoulder clicking the buttons for you to initiate a trade. It all comes back to yourself. It's like it really is like having a staring contest with yourself in a mirror. That's a way that I like to describe it. So yeah, I try to tune out the noise as much as I can, focus on the price levels, and when things get a little chaotic, just step back and wait for the dust to settle before taking my shot.
Nice. Yeah. Let's talk about the Fed for a second, as you have to obviously look at interest rates when you're making trades. And now we have a new
Yeah.
chairman, Warsh, coming in. Take a look at these 5 task force and some of his new initiatives. He's only been in the chair, one meeting, I believe. What jumps off the page from his new initiatives and these task force and just the transformation coming over there at the Fed?
Well, and this might be a little controversial, but one of the things that he said that I actually appreciated is they want to dial back a little bit on some of the forward guidance rhetoric, and just hey, we're not going to be explaining all of our policy moves as much going forward, and I think that's a good thing because you have this whole industry out there of quote unquote Fed whisperers that are always giving these inside takes on the Fed and what they're going to do, and it quite frankly never materializes. And people are always making decisions and trading around this type of stuff. And so I'm a big believer that less is more. I mean, the average person has really, aside from just looking at where the interest rates are, you don't need to understand every single thing that the Fed is doing at every given moment. So mainly because it's all priced into the market, right? So focus on the thing that's actually going to pay you. It's like listening to the gossip and drama versus actually doing what you need to do, right? Because that's really all it comes down to. So I actually appreciated that. He has a reputation of being a bit of a hawk. I think later this year, I wouldn't be surprised if we saw some sort of rhetorical pivot. It's kind of a 50-50 now whether they're going to raise or lower rates this fall. I know Trump wants the Fed to lower rates, but they might need to raise rates first before they lower rates. That's kind of why I opened today's session with some of the stress in the bond market that I'm seeing because long-term rates have been rising a little bit, which in some ways is not a bad thing. It means the yield curve is steepening, the economy is starting to pick up a little bit, but yeah, there's definitely some things that are out there that the Fed needs to be careful with liquidity because if they start raising rates again and oil prices are high, something's going to break and you're going to get a nasty sell off again. But that's part of the business. That's where the most opportunities lie is around those corrections. So yeah, it's too early to judge Warsh. I want to give him some time. I think overall Powell did a good job, during his 10-year period, and I think Powell missed an opportunity in 2025 to lower rates, but I think that was more out of a personal spat between him and Trump. So, yeah, we'll see what Warsh does next.
Really? So you think Powell didn't raise rates or lower rates in 2025 for personal political reasons? Interesting.
Well, yeah, I mean, I don't know if it was political because Powell's supposed to be a Republican, but I think
He was
yeah.
appointed by Obama.
What's that?
He was appointed by Obama. But yeah, I know what you're saying.
Was
I
he?
know
I
what you
thought I
mean.
thought I
Like he
thought
was
Powell was
appointed to the
appointed under Trump.
to the Federal Reserve by Obama, and then
Oh, okay, okay,
Trump made him chair. Yeah, then Trump
yeah,
Trump made
yeah,
him
yeah.
chair.
That's right because it was
That's what I mean.
2016. Yeah, yeah, it was after
Yeah.
Janet Yellen. But yeah, no, he is. I think he's a registered Republican. But they had their
Yeah.
personal differences, and I think that they actually missed an opportunity to lower rates in 2025. And so now, then you had this big spike in oil. There's no chance they could have lowered interest rates, at the beginning of this year. And now oil's in limbo and it just becomes a lot more dangerous. The last thing you want to do is cut interest rates into soaring oil prices. So yeah, we'll see. Oil coming back down now, that kind of gives the Fed a little bit of breathing room to reassess and make some decisions. But yeah, there was an opportunity missed there, and the Fed is kind of notorious for missing out on opportunities like that, either cutting too late or raising too late. That's pretty much sums up their entire history.
Yeah, that's the Fed. I mean, Alan Greenspan was great until right at the end where he just he saw what was about to happen with that housing bubble. It's kind of like, all right, it's on to you,
Yeah,
Bernanke. You got this thing
yeah,
taken over. But
yeah, yeah.
yeah, it'll be interesting to see. What do you think the inflation? Do you think they'll ever get to that 2% target?
No, I think that's over. I think they're going to abandon that. I think they have to. They might change it to 3%, but I think this even ties into like what I mentioned earlier, when Warsh said, "Hey, we're gonna change some of our forward guidance." I don't think they'll explicitly say anymore, "Hey, we're abandoning 2%." I think they'll just say, "Hey," I think they won't talk about it. They'll just say, "Hey, we're struggling to do this, and it's just gonna be at 3-4% now, and you're gonna have to live with it."
Maybe. Yeah, it could be interesting because he also in this meeting pointed that he wants to look to the what he said, the left of the decimal now. So maybe if he sees like 2.9, he's like, we reached 2%. I don't
Yeah,
know.
yeah, 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 yeah.
Do you think we'll see any like deflationary oil prints after or inflation prints after we saw oil spike so high at the beginning of the war and then it came back down? You think we could see some deflation, like negative prints in the next couple months?
No, and I don't think we'll get negative. I think we'll get disinflationary prints, like, if we're going from 4% to maybe 3.5%, but no, the inflation's not going away.
Yeah, actually, the inflation is here to stay. Do you think it's more like a stagflationary situation at this point? I'm sorry, Gianni. What'd you say with the stagflation?
No, no, I'm not actually in the stagflationary camp. I think they're gonna try and run the economy hot. I mean, you look back historically when we've been in similar macroeconomic situations. I mean, really the only way we can manage our debt at this point is to shoot for higher economic growth. I think you're gonna see eventual more deregulation, or you're gonna have to go the austerity route. And that's what Europe did after the global financial crisis, and their economy has barely grown. So, the U.S. is a bit more dynamic economically, and I think our solution to the debt problem, the sovereign debt issues, is going to be accelerating economic growth. That's the only way. But when you do that, inflation is a symptom of a growing economy.
Oh, yeah. And hopefully prices can keep up. our wage growth can keep up with the price increases
Right,
that we're
right.
seeing.
That's the key. That's the key. Yeah.
I'm gonna take a hard left here and shift into crypto. Do you look at crypto over there? Have you studied any crypto, what you're doing over there at Gianni?
Oh yeah, yeah, yeah. I've been trading crypto since about 2013.
Let's talk about that a little bit. Because there are so many people who now, you've seen the Bitcoin winner, everyone saying crypto's terrible. I had to actually did an interview with a guy. He's one of the most bearish crypto people I've ever met in my life. So like
Okay.
what are you seeing in the crypto markets?
Well, crypto, we're in a bear market right now. We're in a downtrend, making lower lows and lower highs. People talk about this 4-year cycle that exists. It's pretty evident that there is one. So I'd like to see Bitcoin hit a bit lower prices. I'd love to see it drop as low as 40 to 45,000. But there's probably going to be some support, 53, 56,000. I'm really not that excited about Bitcoin if it's below, basically 70 to 75,000. I think you get back above there, you can start talking about a bottom. But until then, the bears are firmly in control. But when it comes to Bitcoin, my concern is, that was the trade of a generation, right? It's kind of like getting a mortgage back in 2020, right? That was a generational trade. And I think the problem you have with Bitcoin is that people have unrealistic expectations. I don't think you can expect, 100,000% returns over the next decade in Bitcoin. In fact, I'm even in a camp, and I do, I make a lot of the crypto crowd a little upset when I say this. I trade crypto. I'll buy Bitcoin at 40,000. I'll buy Bitcoin at 50,000. But similar to what stocks have experienced in the past, I'm not ruling out a lost decade in Bitcoin. And what I mean by that is that Bitcoin might not make a new all-time high for another decade. Now, does that mean you never want to own Bitcoin or you can't trade Bitcoin? Absolutely not. I mean, if Bitcoin goes to 40,000 and then rallies back up to 80, 90,000, that's more than 100% return, right? That's a nice trade. But the set it and forget it style that many people got comfortable with, you know, in the first half of this decade and the back half of the 2010s, we're in a different reality now. I mean, it's just not the same market. It's hardly the Wild West. You're not a rebel against Wall Street for owning crypto anymore. It's completely institutionalized, and that's just the way it is.
Crypto, Bitcoin is definitely not the trade that it once was. Are there any other tokens or any other like Ethereum seems
That's
to be a
okay.
big thing? Are you investing on the blockchain or any other ways? Yeah.
Uh, yeah, I mean, I think eventually Ethereum and Solana might be interesting, but right now, Bitcoin is kind of like the tide that lifts and lowers all ships. So when we bottom, yeah, I'll probably look at Ethereum and Solana, but for now, I mean, I'm just avoiding the space entirely.
What about gold? The metals have had crazy memish moves here lately, but that's been pulled back. Is Gianni now frozen? You're back.
Yeah, I think we're setting up for a big buying opportunity in precious metals this quarter, preferably, mid to late August, September. But yeah, I don't think the precious metal story is over yet, but I do think we have a little bit more downside before it bottoms.
Got you. And then, like, are you interested in copper when it comes to the AI build out, or are you more a guy who's looking at the glass, like maybe a Corning play when it comes to the AI build out? I'm assuming that's what you're basing these metals off of, or are you just basing them on the gold as a play for against inflation and central banks? What's the whole
Yeah,
precious metal thesis
I
when you're
do
hedging
more
that?
gold and silver as a play against the central banks. Yeah.
Got you. What metals do you see for the AI build out? Any
Copper
plays
is
on
a
the
big
AI
part of
build
it.
out that you're
Silver,
seeing?
some of those rare earth minerals. I track those stocks. Those ones interest me quite a bit.
Got you, got you. And then so another question, I guess, with your normal portfolio that you have, Gianni, what does that kind of look like for a guy like you right now? How is it constructed? You don't have to give us like individual positions, but is it like a lot of metal, probably zero bonds, and I'm assuming, just a lot of equity, a lot of crypto.
Well, actually, I do own some T bills. I have different buckets. I have accounts that I actively trade, and I have accounts that I kind of just let ride. But I do own some T bills in an account that I don't trade. But I still got actually in my active account, I got a little bit of cash on hand here. But right now, I'm mainly exposed to tech and biotech. Biotech is a sector I'm very excited about. At the moment, I think that's the next phase of AI. Even the CEO of Anthropic, Dario Amodei, seems to think that biotech is an important up and coming sector in the AI trade. So yeah, I'm hot on biotech right now. I still like tech. I've really scaled out of chips, semiconductors over the last couple of weeks. And I'm starting to look at some opportunities in the consumer discretionary, the retail space. I think that we'll be pleasantly surprised here in the next quarter or so. So we're in a bull market still. Things are looking good. You'll get dips, you'll get corrections, but yeah, in my active accounts, you are right. There's no bonds. There's no actually no metals right now. No crypto right now. It's just straight tech, straight biotech, and looking for some selective
How
consumer
active are you
retail
in those
themes as
active
well.
accounts? I'm sorry, how active did you say you are? Or does it just depend on the position?
Oh yeah, no. So tech, biotech, and a little bit of cash right now.
Got you. Are you moving from software over semis now? That seems to be a trade that's moving.
I think that's a good play right now. Yeah, yeah, yeah. I think there's some value in software at the moment.
What about what about international versus domestic? Did you say I'm sorry, what did you say your mix was with international versus domestic, Gianni? I'm lagging.
I'm pretty much all domestic right now.
I think I read your lips. I hear you
Yeah, all
keying. I hear you
domestic.
keying. Look, no worries. We're struggling with this stream. Yeah, domestic. I got you. American exceptionalism continues. And let's take a few minutes before we hop off, Gianni. Just tell people more about yourself, more about what you do, more about what's happening over there. Let the world know so they can find you and what you do. Can you tell the world a little bit more about what you're doing over there, Gianni? What your day to day is like, where they can find you, what's happening in your world?
Yeah, well, I trade pretty much full time. That's what I do. I'm always doing research and sharing my research with my peers and the people that tune in. But yeah, I'm all over the place. You can find me at MMA Cycles. You can find me at Theo Trade. You can find me at Benzinga. I have good relationships with all of them, and it's all about trading different markets and different opportunities, different time frames. So, yeah, you can find me a little bit all over. I got my X account at Gianni_Di Poce, and I got my book Esoteric Economics that I published back in December of 2024. And yeah, just staying busy. That's the life of a trader.
The fun days, the fun life of a trader. Specific stocks that you're looking at right now, not recommendations for anyone listening.